Welcome to Talking Markets with Franklin Templeton. I'm your host, John Chagetsky from the Franklin Templeton Global Marketing Organization. As a forward-thinking asset manager, Franklin Templeton leverages cutting-edge strategies and deep industry insights to unlock opportunities to help grow wealth. We're your trusted partner for what's ahead. We're here today with ClearBridge Investments Head of Economic and Market Strategy, Jeff Schulze. ClearBridge is a specialist investment manager of Franklin Templeton, and Jeff is the architect of the Anatomy of a Recession program, a program designed to provide you with a thoughtful perspective on the state of the United States economy. Jeff, welcome to the show.
Great to be here, John.
Jeff, let's start today's conversation with your view on the U.S. economy and the current state of the ClearBridge Investments Recession Risk Dashboard. Are there any changes with your update at the end of January?
Well, John, we did have manufacturing PMI new orders move from red recession all the way up to green expansion. Very rare for an indicator to jump 2 notches, but new orders jumped by 10 points and it now reads at 57, which is well into green territory. Now, this is a positive development because manufacturing has been languishing in the economy over the last couple of years, and this could signal that this is an area that could drive better economic activity in the year ahead. But when you look at the 12 signals from the ClearBridge Recession Risk Dashboard, you have 1 red, 2 yellow, and the rest are green. And importantly, the odds of a recession over the course of the next 12 months has dropped to 20%. So the dashboard continues to improve. And I think that that will be something that materializes even further as you move through the course of this year.
So the dashboard is clearly signaling an all-clear expansionary view. What do you think will drive the economy in 2026?
I think consumer spending is going to be a big part of this year's story. And I also think you're going to see a boost from business investment, and it's going to move still into AI, but it's going to be a lot broader than what we've seen. So when you think about consumer spending, I think the consumer is going to be well supported for a number of different reasons. First off, in the next couple of quarters, most lower and middle income consumers are going to get a large boost in their tax refunds from the One Big Beautiful Bill. So that should create much more of a uniform consumption picture than what we've seen over the last year or two. You are going to continue to see the wealth effect support upper income Americans and their spending habits this year. And although wage growth is moderating, it's moderating at a slower pace than inflation. So real wage gains are going to increase affordability and purchasing power. The consumer has always been the bedrock of the U.S. economy. I think that that will continue this year. Now, looking at business investments, the new tax incentives from the One Big Beautiful Bill should create a much broader CapEx cycle than what we've seen. If you put on top of that reduced policy uncertainty and easier financing conditions, I think that this is going to be a really good year from an economic perspective. And right now, consensus expects about 2.1% real GDP growth. I think that the economy is going to come in comfortably above those levels.
Well, Jeff, there definitely have been some pretty high-profile layoff announcements this earnings season in the headlines. How concerned are you with that?
Well, there has been. UPS announced 30,000 job cuts and operational roles. They're winding down the Amazon delivery volume, and they're right-sizing their headcount. Amazon continues to normalize their headcount after overhiring in the aftermath of the pandemic. Nike and Pinterest announced about 800 cuts each. This isn't necessarily related to AI adoption, which is the big fear that's out there. It's really a mix of cost cutting, post-pandemic adjustments, and restructuring. I think we're going to go from around 30,000 jobs created per month, which is the 3-month average that we have right now, up to 60 or maybe 75,000 per month, which is going to be enough to support the consumer, but it's also going to be catnip for corporate earnings because compensation is one of the largest costs in a company's cost structure. And the one thing to really monitor, as we've talked about on this podcast time and time again, is initial jobless claims. which is the number one variable in the ClearBridge Recession Risk Dashboard, claims continue to be in the low 200,000 range, which is a really good development.
Jeff, the Conference Board's Consumer Confidence Survey plummeted last month and is now at levels last seen, I believe, in 2014. Why is there such a disconnect between the confidence surveys and actual consumer spending?
Well, the low hire, low fire environment isn't helping confidence in the labor market. Our job sentiment measure is at levels that are consistent with a recession because of this low churn type of labor environment. But when you look at the decline in that survey, it was across all demographic groups. There's not only concerns about the labor market, but there's higher prices and tariffs. And there's been a disconnect with these confidence surveys and economic growth for about a decade. There really hasn't been a relationship with the two of them really since the middle part of the 2010s. And I think it comes back to a number of different reasons. First off, whether you're looking at the Conference Board survey, which we've been talking about, or the other survey, which is the University of Michigan survey, both of them changed their data collection methodology. It's online now, when it used to be either by phone call or by mail. So I think that is probably distorting the data to some degree. Also, in the aftermath of the global financial crisis, the U.S. has become increasingly politically divided. So when one party is in control of the White House, the opposite party tends to be much more negative. So, for example, if you have a Republican president, Democrats are much more negative in their responses and Republicans are much more positive, and vice versa. So I think that is playing in here. And then lastly, I think social media does impact how consumers view the economy. It creates a warped view of reality. Everybody kind of posts their stunning milestone or vacation that they're on. Rarely do people post bad days, and it creates this warped image of reality. And the uncommon seems more common today, which really weighs on how people view the economy, and it results in a negative skew to these sentiment surveys. But what we've been saying is that the number one driver of consumer spending is the labor market. And the labor market continues to hang in there. And as long as that's the case, even with some of these negative consumer sentiment surveys, we think the consumer and their spending is going to be just fine.
So, Jeff, let's transition to the capital markets. If I recall correctly, you were pretty constructive on your outlook for equities in our last podcast. Is that still the case?
Yeah, we are still constructive. If you think about the policy backdrop that we have right now, this is something that you rarely see. You have the twin tailwinds of both monetary and fiscal policy support this year. That is a combination that you rarely see outside of a recession. The economy is going to get about $300 billion worth of additional governmental spending this year. The Fed has cut 75 basis points over the last 4 months, and the Fed is now expanding its balance sheet. And when you look at the tariff side of the equation, you're likely going to have peak tariffs with the year-over-year comps going negative in the middle of the year. And that's even before the Supreme Court decision comes into play about the legality of the IEEPA tariffs. So you have all of this stimulus happening in an environment where earnings are accelerating here in the US and overseas. So yeah, we're still pretty constructive on the markets this year. Although you're seeing some volatility here to start off the year, we think that the path of least resistance is higher.
So, Jeff, after 3 consecutive years of 15 plus returns for the S&P 500, is it possible we're overdue here for a bad year?
I understand that mentality. People always think that mean reversion has to happen and you need to have a negative year. But when having 3 consecutive 15+% returns in a row, that's actually happened 4 additional times if we go back to 1940. So this is year 4 following those 3 years of really strong returns. When you look at year 4 at those other periods, 3 out of 4 of those times, the market delivered another 15+% return. That happened in 1945, 1952, and then in 1998. The only year where you actually had a negative return was in 2022. So an object in motion tends to stay in motion. And given all of those supports that I talked about a second ago, I think we're going to have another positive year in the markets. I think 15% may be a stretch, but I do think that we could get to high single digits or low double digits when all is said and done.
Let's talk a little bit about a theme that you've been anticipating for quite some time, broadening in the equity market. Over the past 2.5 months or so, there's been a strong rotation from the former leaders to the laggards across the U.S. equity complex. Can that continue?
It can continue. If you look over the last 2.5 months, it's been a pretty strong rotation away from the Mag 7 and mega cap tech, and again, into some areas that haven't fared so well since 2023. In January, the Russell 1000 value outpaced growth by 6%. The Russell 2000, which are small caps, outperformed the Russell 1000, which are large caps, by 6.9%. And the Mag 7 returned just 0.6%. So you're seeing a rotation, and a key dynamic here is that the Magnificent Seven stocks are no longer the only game in town when it's come to earnings growth. When you look at earnings expectations for 2026, Mag 7 is expected to deliver earnings similar to small and mid cap stocks, and that gap between the Mag 7 and the rest of the S&P 500 has narrowed dramatically. And when you have broad earnings delivery, investors will go to those cheaper sources of earnings growth, which is the rest of the U.S. equity landscape. And to talk about valuations, typically small and mid cap stocks trade at valuation levels similar to the S&P 500 going back to 2002. Today, they trade at a discount of about 6 turns. So this is one thing that's been driving this rotation, this earnings and relative valuations. And ultimately, I think that will continue here in 2026 for at least the next 6 to 12 months.
Jeff, thinking about the importance of earnings growth, what are your takeaways so far from the Q4 earnings season?
Well, it's been a great season so far. Not as good as Q3, but it's been pretty solid from a results standpoint and from a guidance standpoint as well. Now, the beat rate, we're about halfway through earnings season, is 6%. If you look at the number of companies that are beating on earnings, revenues, and both metrics, above the average that you see at this point in the earnings season. Commentary has been upbeat, guidance has been strong, and I think that this is something that can continue to drive markets here in 2026. And as I mentioned on last month's podcast, I think this year is going to be a year that's driven by earnings growth rather than valuations.
Jeff, how about the non-U.S. equity space? How are the overseas markets doing so far here in 2026?
Well, as we currently speak, the S&P 500 is up a little bit less than 1%. But if you look at the EFA, which is developed non-U.S. or emerging markets, the MSCI indices, they're up close to 6% and 9% respectively. So you've seen a rotation not only from a market cap perspective and a style perspective here in the U.S., but you're seeing it from a geographic perspective as well. And just like I talked about, investors will go to those cheaper sources of earnings growth with mid caps and the rest of the S&P 500. Same thing is true with global equities. Global equities trade at a huge discount to the U.S. I think from a longer term perspective, it may make sense to add to your non-U.S. exposure.
Is there anything out there that could derail your fairly bullish outlook?
There's always something, John, that can derail a bullish outlook. People talk about the Sell America trade. Whenever you have any geopolitical events that pop up, anything on trade, some of the wars that are going on here, you have seen the U.S. dollar sell off, long bond yields sell off, U.S. stock market sell off. But again, I think at the end of the day, capital flows to the places where returns are the highest, and U.S. assets have and continue to be the most profitable in the world. There was a term that we used to use, TINA. There is no alternative to owning American assets. I think that's still true to some degree, but again, I do think that the non-U.S. space, given valuations and that market concentration, makes sense to have an allocation to. So, I'm not necessarily a believer in this big allocation away from U.S. assets on a sustained basis. What could derail our view, though, is inflation coming back in a strong way in the second half of the year. You have a lot of stimulus coming into the economy. Commodity prices are broadly higher. And if inflation does become problematic, that would create a situation where the Fed won't cut in the back half of the year and potentially could start to raise rates, which would pressure valuations in the equity markets. But my view is that's not going to transpire. I think inflation will continue to move lower and may get close to the Fed's 2% target by the end of the year.
Jeff, the equity markets initially sold off when the announcement was made of Kevin Warsh as the nominee for the U.S. Fed chair, but then they rallied back after that initial somewhat knee-jerk reaction. Do you think that he is hawkish or dovish for equity markets?
Well, the market certainly thought that he was hawkish in the very beginning of the release of that news, but the markets actually closed the day flat. If you look forward to the following trading day, the markets were up pretty substantially. So although Kevin Warsh is known as a balance sheet hawk, and this is because when he was on the FOMC back in 2011, he disagreed with QE2. He thought that would cause inflation, and he ended up stepping down because of that. And over the last 15 years, he's criticized the Fed on the size of their balance sheet. He is dovish on the rates side of things. He's been advocating for lower interest rates for about 3 years. But ultimately, the FOMC is 12 voting members when it comes to monetary policy. It's not just one individual vote. And given the fact that the FOMC recently decided to start to increase the balance sheet again through reserve management purchases because of some of the volatility that you saw in short-term funding markets, and there weren't any dissents with that vote back in December, I think that it's going to be a very tough situation for Kevin Warsh to bring down the balance sheet in a meaningful way. So if he's going to be advocating for more rate cuts and the balance sheet isn't really going to change that much, I think that that's going to be a Fed chair that's going to be supportive of risk assets as we look forward.
Okay, so Jeff, as we look to bring today's conversation to a close, do you have a final thought for our listeners?
I think the market is going to be volatile this year. Usually the market is volatile when you have high valuations, but we continue to be buyers of dips. Yes, today looks like the late 1990s. You have high valuations. You have had a really good run for the markets. There's an infatuation with growth stocks, but I think there's a lot more differences than similarities given the policy supports that are in place right now and the earnings growth that you're seeing in the market more broadly speaking. So we continue to believe that this rotation, this broadening will occur. So diversification is going to be much more additive to your portfolios.
Jeff, thank you for spending your time with us this afternoon in the studio. To all of our listeners, thank you for spending your valuable time with us for this update today. We hope you've enjoyed it. If you'd like to hear more Talking Markets with Franklin Templeton, please visit our archive of previous episodes and subscribe on Apple Podcasts, Google Podcasts, Spotify, or just about any other major podcast provider.
As mentioned in the podcast, the Magnificent Seven are Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. This material reflects the analysis and opinions of the speakers as of February 4th, 2026, and may differ from the opinions of portfolio managers, investment teams, or platforms at Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the date of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. What are the risks? All investments involve risks, including possible loss of principal. The value of investments can go down as well as up, and investors may not get back the full amount invested. Equity securities are subject to price fluctuation and possible loss of principal. Small and mid-cap stocks involve greater risks and volatility than large-cap stocks. Fixed income securities involve interest rate, credit, inflation, and reinvestment risks, and possible loss of principal. As interest rates rise, the value of fixed income securities falls. International investments are subject to special risks, including currency fluctuations and social, economic, and political uncertainties, which could increase volatility. Treasuries, if held to maturity, offer a fixed rate of return and fixed principal value. Their interest payments and principal are guaranteed. There is no assurance that any estimate, forecast, or projection will be realized. Diversification does not guarantee a profit or protect against a loss. Investors cannot invest directly in an index, and unmanaged index returns do not reflect any fees, expenses, or sales charges. Past performance does not guarantee future results. Any companies and/or case studies referenced herein are used solely for illustrative purposes. Any investment may or may not be currently held by any portfolio advised by Franklin Templeton. The information provided is not a recommendation or an individual investment advice from any particular security strategy or investment product and is not an indication of the trading intent of any Franklin Templeton managed portfolio. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton, FT, has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and/or their distributors as local laws or regulation permits. Please consult your own financial professional or Franklin Templeton institutional contact for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Templeton, 1 Franklin Parkway, San Mateo, California, 94403-1906, 800 dial Ben, 342-5236, franklintempleton.com. Investments are not FDIC insured, may lose value, and are not bank guaranteed. Issued by Franklin Templeton outside of the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2026 Franklin Templeton, all rights reserved. Podcast theme music by Adam Vadovsky.